talking about is sort of the valuation, sort of resizing, if you will. And I know that we don't necessarily follow the markets on a day-to-day basis, but to the extent that that volatility impacts your investing, how do you see all that playing out right now?
Yeah, I mean, this is not new. This is not a new place for us. So at Bessemer, a lot of our focus is on cloud stocks, recurring revenue software investing.
Yeah.
And for the last 20 years, for the most part, they've been here. They've been trading at 6 to 10 to 15 times revenue. Smart people can debate, should they be higher, should they be lower? But smart people were not debating last year, should they be at 40 and 50 and 60 times revenue as they were.
Right.
So this feels like a new normal, but it's a place that's familiar for us for the last 2 decades.
I think it's interesting, though, particularly in the big cloud businesses, the subscription services, the software as a service, the SaaS businesses. That's been sort of a standout where people like the business model, and more importantly, there's a path to profitability. Is a lot of this about companies that have a grow at any cost and are willing or able to turn a profit?
I think the valuations reset has affected every single company in the SaaS index for sure, but absolutely if you look at the top 10 SaaS companies that we track in the index by market cap, they are all cash flow positive with maybe one exception. They run 20% free cash flow. So these are businesses that have proven their ability to generate cash, and clearly the businesses that can generate cash are the ones that are being favored a little bit more in this market reset.
I think when we're speaking at the Greater Boston Chamber of Commerce, a lot of the conversations have been about the health of the economy and a lot of the inflationary impacts. What extent, if any, do you have on seeing sort of the macroeconomics on sort of your world of investing and looking at companies?
Yeah. Not many of our companies face a big inflationary dynamic because they're software, so they don't have huge input costs, with the exception of labor. So the talent, the engineering costs have been insane in the last few years. And so what's happening right now is these companies reset, is they all realize they can't raise capital at the cheap prices they used to. And that means they've got to save money somehow. And what that will bring will be layoffs, will be hiring freezes, and we're seeing it in a number of our companies right now. And that means that pretty soon talent, I believe, will be on sale. The cost of engineers, the salaries paid for engineers will absolutely go down.
So maybe a right sizing in the market to some extent. What are you advising CEOs, entrepreneurs of some of the companies within your portfolio about what to do to save that cash, to prepare for a downturn if there is one, and how to set yourself up for success in the next 12 months?
We're not really saying if at this point. We're telling them it's almost a certainty that we're going into some version of a downturn, especially for them. And so what that means is they should prepare to not raise money as long as they can possibly avoid to not raising money. So there is some private capital still available for these startups, but it is going to be very scared, very nervous, and very hard to come by. So the best startups in the world will be smart enough to not go out into the market for the next at least 18 months, if not 24 and further. So they're all prepared to go that distance. Think about their runway, think about how far they can get without raising any more capital.
Do you then wait to deploy some of the capital if you think valuations or, like you said, talent on sale 12 months from now? How do you deploy that capital?
If 2008, 2009 is any guide, the next year will actually be pretty slow. Even though in theory, the valuations of startups should be lower, the best startups won't be raising unless they're absolutely forced to. And so it'll be a year from now, a year and a half from now, when valuation resets have really filtered through the market, that founders and entrepreneurs will be ready to go back out to the markets. And hopefully for many of them, they'll have grown. So they'll be much more valuable than they are today if they raise anyway in a year. But that's my guess, is that most venture capital will be pretty slow for the next year, and then we'll begin to pick up as the market slowly comes back to life.
Does that mean more M&A, more consolidation?
Absolutely. So, there's a set of businesses in the world that were never viable and probably shouldn't have been able to raise money. They will go out of business. I think we'll see some very big name liquidations and bankruptcies. There's another set of businesses that are pretty good businesses, but not incredible, and don't have enough cash to make it through this timing, and they will all be talking about M&A. They'll be seeking buyers, and the buyers are already sort of licking their lips thinking this might be a time to tuck in a few other companies.
Interesting. Of course, we're here in Boston, and we're on the East Coast, and we're talking about some of the big tech startups and the innovation. When I was in San Francisco in 2019, it was during the big sort of WeWork debacle, and there was a lot of conversations about unicorns and unicorn status and trying to IPO, and then we got SPACs, and then it was a conversation of how do you go public. what do you see as A, the unicorn status right now, and then B, is the SPAC still a good option?
Yeah, so at Bessemer, we're not talking about SPACs much anymore, and we're not really talking about unicorns. We're talking about what we call centaurs. So focusing on companies that can get to real revenue. 100 million of recurring revenue, we're calling that a centaur, and we think this is the year of the centaur, not the unicorns. I think last year there were something like 500 new unicorns minted. That was like 1.5 every single day. That's insane. 10 years ago, it was about 4 a year were minted. So clearly we went through a unicorn bubble, and the meaning of the term unicorn has been massively devalued.
And just quickly, here is an IPO that's still one of the best exit strategies.
Absolutely.
Yeah.
For companies that can control their own destiny, that can get to that free cash flow positive point, going public is almost always going to have the best return for their capital. It's not easy. It's not for everyone. It can be a real pain to be a public company. But for the companies that have huge markets and massive runway ahead of them, going public will still be a good option. Now, that window may not be open for another year in a viable way for many companies.